Hello, private lenders. Ray Burkhalter here with REI Funding Partners, bringing another educational video. And today's content, we're going to focus on our private lending risk management strategy to make sure everyone knows the layers of things that we do to make sure that our private lending deals are solid. Glad to bring this one to you today. So, what we're going to talk about is going to be the 4 tiers of our risk management strategy. So just as an overview, tier 1 is our professional team. Tier 2 is that we meet or exceed the risk metrics. Tier 3 is that we fund projects local to the Southeast. And then finally, tier 4, the risk management table. So let's jump right in on tier 1, our professional team. So my wife Gail and I are the principals of REI Funding Partners, and we have 17 years plus of years in real estate investing. That started with us buying and fixing properties, owning rentals, and then in 2011 we got into the private lending side of real estate investing and began funding the kind of deals that we used to purchase ourselves and manage hands-on. So a lot of experience there. In our marketing and sales department, we have a real estate investor that has even more experience than we do, and she's running the marketing and sales department and in control of the messaging that goes out, and that works its way into the people that we reach out to, the best of the best for doing our lending. Next, in our operations department, a couple of things here. Our operations manager is an experienced rehabber and property manager himself. So he also has the hands-on experience of buying, fixing, owning properties. He's just closed out a new one this week that he purchased, and it's being renovated at the moment. And then our loan processor has over 20 years as experience working in a closing attorney's office as the closing agent. So she has seen many, many, many closings and is really excellent at title work, all phases of closing. So real blessing to have her on the team as well. And then finally, in our finance department, our latest addition to the finance department, Jackie, has a degree in commerce and business administration for professional accounting. So it's excellent to have someone with a focused degree in that area. So a really strong professional team that we have running the show here. Now, tier 2, meeting or exceeding risk metrics. Let's take a look at a couple of factors here. Loan to value is one of the biggest things that private lenders look at. Banks are lenders too, and so they're looking at loan to values, and they'll typically lend up to 80%, sometimes higher on certain loan programs. For us, we're more risk adverse, so we're more conservative. So our loan to values top out around 70%. In some cases, we don't go higher than 65%, depending on the borrower and the project. So ours are significantly safer, and we adhere to those metrics with each and every loan. Borrower experience is another metric that we look at. So we want to see at least 3 successful projects from people that we lend to, or other compatible experience. Sometimes they don't necessarily have the completed projects, but their experience is really strong in the construction area or in real estate. But otherwise, we're going to require them to partner up with another experienced real estate investor if they have a good deal, but they just don't have the experience yet. And then finally, cash reserves. Part of our underwriting process is to make sure that our borrowers can show 3 months of cash reserves on hand. So those are some of the main risk metrics that we look at and we meet or exceed for each deal. Tier 3, funding projects that are local to the Southeast. So we are based in Tuscaloosa, Alabama, near the center of this circle. And so the real estate that's in the market in these states and some other states in the Southeast is historically steady, not huge rises in prices, not huge drops in prices. The typical trend has been a slow and steady gain in our area. and it's nice to have stable assets like that. Within the radius of the circle that you see on the screen here, we are less than a 4-hour drive from several key cities that we are currently lending in some of these, but not all of these. But by having things in a nice driving radius, it's really helpful to go meet with the business operators that are there, some of the other providers for the projects that we do. It's just, we feel a good safety factor to be able to be within a reasonable driving distance. And then finally, sticking to a region gives us better control over the projects than trying to do projects all across the U.S. Our systems would work for that, but we just prefer from a safety standpoint, the way we're structured at the moment, to keep deals local to our area. And so when you put all these three reasons together, we like funding in the Southeast and areas that are close to us. And finally, Tier 4, our risk management table. So with this table, we identify possible risk events that could happen. We identify some measures to mitigate those risks. With our underwriting, we seek ways to avoid or eliminate the risk up front without, hopefully having to mitigate it. As much as possible, we structure our loans to shift risk away from us as the lender. And finally, at the end, contingency. In the case that the risk event or the action does occur, what will we do in that scenario to deal with that? So let's look at this risk management table that we've developed for our private lending business. I'm going to go through these fairly quickly to keep this video from being too long, but you can always replay or pause and read over this if you like. So risk number one at the top of the list that we see here is what happens if the market drops fast, if it dropped 15% in a year. The mitigation plan for that would be to structure loans with low loan to value as we do, structure loan terms for 1 year or less as we do. The contingency plan, if that happened, we have protective equity in each deal, and that's key. And we do short-term loans to minimize the effect of a market drop. So even if it was 15% in a year, we always build in to the front of the loan more than 15% of equity. Next, if there are damages such as fire or storm damage, we have insurance on each property, or we make sure that the borrower has with us as lender listed as loss payee. So it's required prior to even a closing is a contingency plan. If it were to happen, then filing, making sure that the borrower files on the insurance policy is the next step there for contingency. Next, what if the borrower files bankruptcy? Again, a low loan to value is helpful in that situation. And then borrower having cash reserves is important. What if it does happen? Contacting a bankruptcy attorney to handle the disruption, and that would be at the borrower's expense if that event were to happen. Another risk: what if the borrower operator dies? So we lend to normally to LLCs or S corporations, but what would happen if the main operating member died? Not really a way to mitigate that, but if it did happen, another person within that LLC or S Corp should be able to take over management of it and pay the bills and finish the project if that should happen. But if not, contingency plan would be to find another investor to purchase the project and finish it out. If there was no one stepping up to make the payments and manage the project, if we didn't sell it or find another investor prior to foreclosing, then we could foreclose on the property and take possession of it ourselves. Next, what if there's eminent domain takeover by a local government? Again, low LTV helps to have plenty of protective equity in a situation like that, and keeping loans short in their period. Because normally eminent domain is known about quite in advance. But if it did happen, the government does pay for the property. They don't just take it. And that payment would be required to pay off the recorded mortgage. Next, if the borrower stops paying, what happens? Again, that protective equity, the low loan to value is extremely helpful there. With the down payments that we charge to these borrowers, the borrower has skin in the game. So they have something to lose. So them stopping to make the payments is a rare occurrence because they're in this to make a profit. So not only do they want to make a profit, they don't want to lose the money that they have at risk. But what if it does happen? So again, we have an extensive network of investors that we lend to. First option would be we'd seek to get this borrower to sell the property to another investor to finish it out. But if necessary, we would proceed with a foreclosure. Next, what if there's a title issue with the property? We always have professional closings, as you see here, on these properties, and that is a key mitigation factor. We also require lenders title insurance, which is another key mitigation factor to make sure that the title is clean before we go in. But in case anything did get missed somehow, because of the lender's title insurance policy, we would file a claim on that, and they would pay to get things cleared up. And then finally, at the bottom of the list, what if the borrower is trying to get a draw on their construction money, but they haven't completed that phase of the work yet? So some mitigation plans, we have a draw process that includes a visual inspection of the property to make sure that the work is done. Also part of our draw process is getting invoices to prove that the borrower has completed the work and paid for that. The contingency plan there would be that the draw would be denied, or it would be a reduced amount to pay out for the actual work that gets completed and documented. So this list is most of the possible likely risk in doing a short-term private lending transaction. And so I hope you can see that these things have been thought well through. This has been around for us for a long time. It's what we run our business by, and it's one of the reasons that in doing hundreds of loans, so far we've not lost any principal, and so far we've not had to foreclose on any property. So we're very grateful and thankful by the grace of God. Anything can happen in life, but we work hard to make sure that our loans that we make are really conservative, and we have, I hope you can see from this video, lots of processes and things in place to make sure that they are. So I hope you found this video helpful and informative. If you're not connected with us, we invite you to stay informed with what's going on here at REI Funding Partners. We have a Facebook page, and the address for it is on the screen here. And we also have a growing library of videos like this one and other helpful videos on our YouTube channel. So you can see the URL for that on this page as well. So I have enjoyed bringing this one to you. Hope you found it interesting. Until next time, take care and God bless.